Good evening, everyone. Time for another silver update. This is the weekly chart of gold provided by netdania.com. You can click on the link below. Now, I've drawn in a series of trend lines here to show you that the pattern in gold seems to be the beginning of a parabolic arc. I don't think it's even really anywhere begun to run at this point. You can see that the MACD is now kind of rounding up, and what kind of a move will we get in gold if we get the sort of move like we had back here, or even a stronger move than that? Probably new highs. The news is, well, I shouldn't say the news, but the news that is not really reported is getting very dire. That'll be the topic of the night. But I don't have the silver chart here because silver's really not perking up that much, but obviously it will because it always follows gold. But before I get to the big topic of the night, I want to look at the question of the day, and that is from Vinnick, and it's about trade surpluses. Question is, trade surplus equal inflation? I heard on your show today Argentina was aiming for a trade surplus. My immediate reaction was a face palm, but I started to second guess myself. Doesn't this just create more inflationary pressure by keeping more currency in the country and driving foreign-owned pesos back in? In my quest for understanding, I have come to acknowledge that the United States trade deficit for decades consecutively is the only reason the US dollar has not collapsed already. I've heard that more than half the US dollars are foreign-owned. If we had a trade surplus, these dollars would flow back in, creating a bidding war effect, inflating prices. This is, to me, the biggest reason that the reserve currency status being lost would throw the dollar into an inflationary spiral. So basically, Argentina sounds like it's crashing its own economy in pure ignorance to me. I'd like to hear your thoughts. Perhaps your opinion is different. You could debunk this. What really gets me is second guessing myself. Is that China doing this too? I wonder even if they own enough dollars that will send us such an inflationary spiral. So, excellent question. Very complex topic. Now, let's start with this situation about if we had a trade surplus, the dollars would flow back in. Now, you can't compare the United States to other nations. The main reason being the petrodollar standard. The United States is the world's reserve currency. It's the world's reserve currency for a reason, and that reason is the petrodollar. If anybody in the world wants to buy oil, they have to buy dollars first. That causes an enormous requirement of dollars to be out there as foreign exchange reserves held by central banks, held by businesses, held by anybody who wants to buy oil. They can also buy just about anything else in the world if they want to use dollars. And there are many other commodities that are priced pretty much only in dollars. So that is a big, big advantage that no other country has. Now, normally a country keeps a country that has a trade surplus keeps that surplus in various currencies or whatever they choose to keep it in that's in their interests. Now, a trade surplus is going to be generated when the country exports more than they import. So if a country such as China exports a whole bunch of stuff but doesn't import a whole bunch of stuff, eventually they're going to pile up currency because that's the difference. They're getting more currency than they're spending. So the big question is, what do they do with that currency? Now, the petrodollar recycling that has been going on for many decades has been to the benefit of Wall Street banks, the U.S. government, the T-bond market, because those dollars have been recycled into those markets. So those dollars do have to come home anyway. Now, as far as the ones that are held as foreign exchange reserves, they don't immediately come home. They're held outside the country. But the ones that are invested, they come home anyway. So the inflationary spiral has already occurred. The inflationary rush of dollars has gone into stocks, has gone into bonds, has gone into these paper assets. So that's an explanation of how the trade surplus works with the dollar, the trade deficit with the dollar. Now, just on the question of a trade surplus in general, a trade surplus, of course, is going to be healthy for a country. You want to have a trade surplus. The best way I could explain it would be an analogy. If you think about a person, imagine a person. Is it better to be a person who produces more than they consume, or is it better to be a person who consumes more than they produce? Obviously, you would want to be a person who produces more than you consume, and therefore the extra is savings. So you end up with a surplus, effectively, a trade surplus. Same thing with a nation. The only issue is going to be, how do you hold those savings? What is the safest way to hold those savings? So that's now Argentina apparently wants to do that. You can't do that by just deciding that you're going to do that. The only way you can generate a trade surplus is to have something that other countries want to buy. The Japanese, of course, were masters of this because they had a very difficult situation, because they're essentially millions and millions, tens of millions of people stuck on a rock for all intents and purposes. And so they don't have any oil. They can't really produce a lot of stuff there as far as agricultural, mining, oil, etc. So they were in the situation in the 70s where they had to find a way of raising forex. They needed to generate foreign exchange, so they were able to buy the things they needed: oil, food, all the things they needed to import. They needed to export something to get that. And the solution that the Japanese found was to basically build a better mousetrap. The Japanese moved into the television market and the automobile market, and through efficiency and through excellent design, the Japanese pretty much took over those markets at that time. So that's how they dealt with that issue. That's how they generated a trade surplus in dollars. That's the same thing that Argentina would have to do if they wanted to generate a trade surplus. They'd have to find out what the rest of the world wants, and they'd have to sell it to them. That's how that works. Now, if we went back to an international gold standard, such as I've talked about in the past, then obviously your trade surplus would be generated in gold. And once a country runs out of gold, then they're going to have to generate some, or they're stuck. They can't import. So that's how that works. A trade surplus is a good thing, but the trade deficit the United States is running it's able to run that because it has the world's reserve currency status, and that is because of the petrodollar standard, that both of which are beginning to weaken. And if they do, we could see even a larger flood of dollars back here into investments, but probably the flood coming back would be investments in hard assets rather than investments in paper assets. And that would be the beginning of the crack-up boom or the hyperinflationary spiral. So hopefully that clarifies that. Now, onto the topic of the day. This is a big topic, and it's just kind of eking its way into the news, and this issue of bank runs. Now, I wanted to start with Google Trends, because you can go to Google Trends and you can see how frequently a search term is being used, and they also create these markers where stories broke that were related to those search terms. But I've taken this chart here for bank run, not plural, not runs, but bank run, and pulled it out of Google Trends, and then I've blown it up here and got a chart here. So you can see a couple of things here. First of all, you can see we clearly have this upward rising trend in bank run, and you can see it's not, well, it does start to appear to take a parabolic curve up, and you can see the latest spike is higher than any previous spike. There was a spike in 2008. We've exceeded that spike. Now, if we look at the news reference volume, you can see there's a tremendous spike here in 2012 that's exceeded any other spike. So this is accelerating. Now, it's no surprise that it's accelerating when we look at some of the news. The first story I want to cover, we covered on the blog, and this is a major Italian bank freezes all customer accounts. Now, this is the notice that was posted. If you want to, you can go to Google and get it translated. It pretty much just says that the customer accounts were frozen. And I'll read some of this. Financial difficulties force Bank Network Investments SPA BNI. By the way, this news story is not all over the place. This news story is kind of just floating under the radar. It's not something that's being talked about in the mainstream media, but as you'll see, the impact is very severe on the people. The financial difficulties forced BNI to begin. Bank of Italy authorized freeze on all customer deposits. On May 31st, Bank Network Investments discreetly posted an announcement on their website they would be freezing all of their customer accounts for a 1-month freeze, citing financial difficulties. The announcement was posted and the bank gave customers 7 days to act before the Bank of Italy approved freeze went into effect. The bank's customers are saying they were completely unaware of the notice being posted and are now just finding out about it when they go to the bank or the ATM for the first time. The media certainly hasn't reported it on the news of the freeze and is only starting to make its way around the internet after a complaint was posted on a popular Italian consumer rights website, Adiconsum, along with a photo of a shutdown ATM, and you can see that there. The freezing of customer deposits in a nation that apparently doesn't have a mechanism like the FDIC to ensure customer deposits against losses has sent shockwaves of terror across Italy, raising fears the customers will lose their deposits entirely. In turn, speculation is growing that other banks in Italy and across Europe may soon suffer the same fate as Europe. Officials announced they are planning ATM and bank withdrawal restrictions. Now, I'm going to go to that story next, but let's look at the BNI story. Here's some anecdotal stuff here. A policeman in Milan sums up the situation. Massimo, a policeman in Milan, speaks for all. When I went to pay the mechanic office for my car, the bankomat did not work, nor was I able to make a transfer. Actually, they took all my money away. Now I have 20 euros in my wallet, a wife, and 2 daughters. What am I going to do? My account is also where my salary goes. What now? And there's the link. An English translation of the suspension. Mediterranean News, Italian, reports how the bank's customers feel as if they had their money stolen from them. Bank ATM network blocks and demand deposits. Terror. A call comes to us from network states, I'm a mother of 2 children. I have 10 euros in the purses. I have blocked everything without even giving me a nod. I have had to open against another to avoid that the next paycheck was stolen from me. You see, people, the paychecks are still going in, but the money's not coming out. Do you have direct deposit? I had to notify the owner of the house where I live because I have not a single euro. I save my money for my children, but I have blocked the bill. I cannot make transfers. I do not allow me even the final red. So there's some translation issues there. The bank where the person sending the appeal has the account is Bank Network. It's a bank has decided to block a transaction for at least a month, creating inconveniences for customers. Meanwhile, the site of the bank questioned reads, no one on May 31st, 2012, etc. That's the announcement. And Investment Watchdog reports Italian bank declares holiday. Very serious and unacceptable, says Peter Jordan, Secretary General Adiconsum. The attitude of Bank of Italy, SPA, and BNI because of highly prejudicial interests to the customers. Bank of Italy, in fact, after extending the receivership of the bank, thus giving the impression of an imminent rescue, then gave the green light for compulsory winding up without giving any prior notice to the depositors, leaving them in no condition to perform any type of operation, even basic ones for daily survival, such as withdrawals, payments, utilities, rates, and taxes. Rainbow Rose Roundtable writes, could this be the first bank domino to fall in the crumbling of the European and then world financial markets? allowing Nasera to be ushered in, and that's the big, Nasera is the big conspiracy $1 trillion story. And there's more. So I'll link this. You can read. Here's all the stories not being covered in the news. Now, let's go to this article about the EU. This is from the Irish Times. June 12th, EU discusses limiting ATM withdrawals. Here it comes, people. It's coming. I've warned you for years now that the precious metals, silver and gold, are protection against hyperinflation and deflationary default. Many of the preppers have become laughing stock due to some of the shows and all the craziness going on. But how smart do the preppers look now? Those people who say they can't buy any food because they don't have any euros. Do they have 2 years worth of food stocked up? Do they have cash stocked up? They have gold and silver stocked up. It's coming, people. It's coming fast. European finance officials have discussed limiting the size of withdrawals from ATM machines, imposing border checks. Why are they doing border checks? I've told you for the longest time that these airport restrictions and TSA and border checks and all this stuff is not about terrorism. This stuff is about capital controls, capital flight. And introducing Eurozone capital controls as a worst-case scenario should Athens decide to leave the euro. EU officials said the ideas are part of a range of contingency plans. They emphasized that the discussions were merely about being prepared for and eventually, rather than planning for something they expect to happen. Well, see, the thing about a bank run is that it's a self-fulfilling prophecy. As people begin to panic, they begin to take their money out. As they begin to take their money out, the officials begin to get worried and they begin to prepare. And when the officials begin to prepare, they begin to, the people notice that and the people begin to prepare more. So it's a self-reinforcing cycle, and that's how bank runs get out of control very quickly. So obviously, in any debtor situation, and the bank really is your debtor, they owe you the money. That's a debt that you need to collect. And in any situation, the first ones there are the ones that get paid, and then the other ones have to fight over the scraps. But with increased political uncertainty in Greece following the inconclusive election on May 6th and ahead of second election on June 17th, there is now an increased need to have contingencies in place, EU sources said. The European Commission said today it was helping with legal advice in discussions of contingency scenarios, etc., etc. So you can read that. And the last article is from BusinessInsider.com. I don't know what the source is of this rumor, but they report that there is slow but creeping realization that this crisis is soon to escalate and that financial contagion with risk to bank deposits, often guaranteed by insolvent states and payment systems, indeed the entire modern financial system, is at risk. There are silent runs on banks in Spain, Greece, and Italy. The Bank of Italy authorized the suspension of payments by Bank Network Investments, BNI, without communicating anything to depositors. It repeats the stories that we've seen. Now, on Zero Hedge today, you had it reported that the withdrawals from Greece, I think there's a lot of stories here, but I believe that what was reported that the withdrawals in Greece had now reached, here it is, $1 billion a day. So now the Greeks, it was just $200 million or $100 million. Yesterday we did an update of the Greek bank jog. They're calling it a jog. noting that between 100 and 500 million per day was being withdrawn from Greek banks based on Kathimaneri reports. 24 hours later, the jog has become a trot, with the most recent estimates from Reuters now estimating nearly double the combined daily deposit outflows from major Greek banks. So here's $1 billion a day. Someone did the math, and I think the math was that it would amount to the equivalent of Americans pulling out, let's see, I think it was 170, no, it was $250 billion a day if Americans were pulling out that sort of money. So it seems to be coming. It seems that this snowball is starting to roll up here. It's in the gold price chart. You can see the bottom really seems to be in, and it's not a time to play around anymore, but it's a time to prepare, because you don't want to be caught like those Europeans who are caught. This is a reality. There are people there who have 20 euros to their name, and their bank is closed, and their paycheck is going to that bank, and they can't get at their money. So this is a reality. This is really real. It's happening, and this is what we've been preparing for. Hopefully we have plenty of time before such a thing comes to the United States, but then again, we don't know. There could be bank runs in Europe which could immediately cross the pond and spread to the United States, and we could have world bank runs in an overnight type situation. So you have to keep preparing, which is you need to prepare, have some cash on hand, you need to have lots of silver and gold, lots of food stocks, lots of water supplies, and all the things that you've been warned about if you've been listening to this this channel and other channels that have been warning you that these things are coming. The world banking system is insolvent. It's going to collapse. It's inevitable. We don't know what it's going to be replaced by, but in the meantime, you need to make sure that you're not one of the people who's left in the lurch. And we'll talk to you next time.